Um, the conversation is being extended from where we ended last time. And we were looking at the costs. We were just trying to lay a foundation to the cost of capital. Of course, weighted average cost of capital work. And from the convo we had, we made mention to us that when you are calculating cost of capital work, it is extremely important that you manage to find the cost of equity, right? You should also find the cost of debt, right? You should also find the cost of preference shares. You should find the market value of equity, market value of the preference shares, right? And the market value of debt. Then when you combine these, you produce the weighted average cost of capital. But what we want to do now in this conversation is to zero in. We want to look at the cost of equity. How do you calculate? How do you find the cost of equity? That's basically our conversation. How do you find the cost of equity as an individual? How do you do those computations? Now, I made mention to us that there are various models that are used to find the cost of equity. These include a dividend valuation model, a dividend growth model, and the capital asset price model, KPM, right? I go over these. The models are the dividend, valuation model, the dividend growth model, and also the capital asset price model. Yeah, these four are the major, methods or models that are used to calculate cost of equity in the conversation that we just made mention. Now, you will see that the data that you are going to be having in the question will be quite different. And basically, it is the data provided in the question that should guide one on the most appropriate model to use. I repeat, your question is among these different models that I have, right? That is to say, model number one, dividend valuation model, dividend growth model, and capital asset price model. Which one do I use? No. The answer is that they are not used interchangeably. Instead, it depends on the data that you have been given in the question. We now have the dividend valuation model. Now, the dividend valuation model is given by this formula. It says price, of equity, or price of shares. That's the market value. The market price of a share is equal to the dividend per share at point T divided by the cost of equity. If you are to manipulate the equation, you can have cost of equity that should be equal to the dividend per share to be divided by the price of the market value. That's the market price of a share. So this is the formula that we use. So the P naught is basically the ex-dividend current market price of a share, like the price per share. Let's say the value of a share is 50 kwacha, maybe it is 25 kwacha, or maybe it's 250 kwacha, whatever the price, that is what we mean by the current market price of a share. Then the D at T is basically the price of the dividend per share. Usually these dividends are charged per share. Yeah? So you say how much is the value of the dividend one is going to receive. That is purely dependent on the number of shares that one has, and therefore the cost of equity shall be the price per share multiplied by the dividend themselves, and that is how that is done. Okay. Having made mention all this, it's important to use an example because an example helps us. For an example, and I read the example in your hearing, the Investments Public Limited Company has ordinary shares in issue that have a current market value. The current market value is same as the price of the share, basically 2/4 ngwe. And the annual dividend to be paid by the business in future years is to be expected to be 0.40, that is 40 ngwe. That's the price of the dividend, right? Dividend per share. And what is the cost of ordinary shares? By the way, the cost of ordinary shares is same as cost of equity, right? That's the other name. The cost of equity shall also be called the cost of ordinary shares. And writing on these few points that I have highlighted to all of us, we are saying that the cost of equity shall be basically the dividend per share 40, 0.40 divided by the price per share 2.20. And when you do your computations, you should be able to find 18.2%. So this is the price, or this is the cost of ordinary shares or cost of equity using model. The dividend valuation model is easier, isn't it? Very easy. Just divide, the dividend per share divided by the what? Dividend per share divided by the share price. Wamana. Just that. Kwasila. Kwada. Okay. Having said all that, I call for any questions. Do we have anyone with a question on the same? Someone has a question, yeah? And please, can you launch your question direct here? What is your question? Can you see the screen and can hear me clearly? Have you understood how to find the cost of equity? We are teaching you how to find those elements to use to make work, right? We need those elements. So we are looking at the cost of equity using the dividend valuation model. Are we good? Can you see the screen and can you hear me? All right. The second example do better to us. Let me just assume the silence means people are able to hear me. And now that is very dangerous from my end. I don't know. Anyways, the company has a dividend cover of 4 times and expects zero growth in dividend, meaning the dividends are not growing at this point. And the company has 1 million ordinary shares. That's a value. That's the market value, market capitalization of the ordinary shares is 1 million, and the market. The company has 1 million. The number of shares. The shares themselves are 1 million, and then the market capitalization, which is basically the value of these shares, right? Ordinary shares times the price of them gives us 50 million. After tax for the next year is expected to be 20 million. What is the cost of equity? So now listen. So to find the total dividends given, the total dividends are just given by saying the earnings per share. Listen, just you need earnings or profit after tax part, profit after tax divided by the dividend cover. That gives us the value of the dividend that we expect, all right? The value of the dividends that we expect. We can divide that using the market capitalization value, and you find 10% as the cost of equity. That's the message being sent, nothing more. Okay? That's the other way. So you should know how to work with dividend covers as well. I've tried to explain in the times when you have the dividend cover. Now let me introduce to you the dividend growth model. I have talked about the dividend valuation model. The dividend valuation model, the take-home message is that it's used when the dividends are not growing, isn't it? When dividends are not growing, you use the dividend valuation model, yeah? But what if the dividends are growing? Like they are growing, they're not remaining the same. Let's say the dividends per share for 5 years ago should not be the same dividend per share this year. For that matter, you will see the change. The dividend stuff started growing. Then we need to employ what you call the dividend growth model. And this is how it does work, and you should be happy, right? So the formula is just get the formula. These formulas may not be provided on exam. The price is equal to the dividend divided by the cost of equity minus the growth, which you can still rewrite and by manipulating the equation as the cost of equity shall be D naught multiplied by 1 plus the growth rate of the dividends divided by the price, market price of a share plus the growth rate, which is same as the D1 over P naught plus D. Maybe what we should take home is that D1, it is same as the D1 is equal to D naught multiplied by 1 plus D. Okay, that's what you just know. They are equal. So when do you use which one? These are not different formulas, all right? We should just know that you have to pay attention to what the question is saying. So look at the nature of the dividends that you've been given, all right? If the dividends that you're dealing with have not yet been grown, which they are current net dividends, all right? Not really after growing them, then that would be D naught. That would be D naught. You need to grow them, okay? You need to grow them. But if the dividends have grown already, been grown, maybe these dividends have moved from where they were many years ago up to where they are now. There has been some growth, right? There is that growth. Then you can use D1. You will use D1. So that's the difference. Don't grow D1 because it's already grown. But if you have D0, you can grow it. Yeah, that's the message. G is basically the growth rate of the dividend. Okay. An example shall do better. If the dividends are expected to grow at 8%, that is your growth. Your growth is 8%, 0.08. Into the foreseeable future, and the expected dividends in the first year was 2, and the present market, this is just the past dividends. Before growing the dividends in the first year are these, right? It's just given as 2, and the present market price is 27. Then the cost of equity shall be basically the cost of equity cost. This dividends, this is not net dividend divided by P naught plus D. So say 2 over 12 or 27 plus 0.08, giving you 15%. So 15% shall be your cost of equity using the dividend growth model. Dividend growth model. Dividend growth model. So that's how it is used. Example number 4 will do better. I think we need example number 4 so that you see the differences. A share has a current market price of, what is the current market price? 0.96. This is the price, of a share. And the last dividends, previous, the dividends were 0.12. Now, they were expected to grow at 4%. They're expected to grow at 4%. What is the cost of equity? Since they are growing, the cost of equity shall be the last time dividends, which is B naught, multiplied by 1 plus the growth rate, basically, of the dividends, 0.04, divided by the share price, 0.96 and plus G, which is 0.04. That's the growth rate. So that your cost of equity can be 17%. I think I've seen the way how different the two formulas are and how they are used. That is the idea behind the dividend growth model. Dividend growth model. I've talked about the dividend valuation model. I have highlighted on the dividend growth model. Let me call for any question. If at all there is any question. Someone has a question? You have any question? Okay. So that's what really that does. However, and then you should be fine. Then it is very important that I explain to you another model, which is called the capital asset price model. The capital asset price model is another model. This is the last model actually used to find the cost of equity. This is the last model. Now, the capital asset price model basically just measures risk as well, and the formula there is given as follows. This is the formula for the capital asset price model. Cost of equity in that case will be the risk-free rate, which is the interest rate either on a treasury bill or the government bond, multiplied by return on the market minus the risk-free rate. This is the formula. This is the return that one receives from the market, RIM, and the risk-free rate, basically the interest rate that one can receive if they invested in the government investments, government securities that are risk-free. And beta, basically, this is the measure of risk that is available in that particular investment. So using this formula, you can manage to do this simple question. Our question is saying, the following information is available on the portfolio of an individual company shares. So the price at the start of the period is that, and the price at the end of the period. Wait. Let me look for this. Okay, let's use this example. Example number 8. Investors have an expected rate of return. Investors have an expected rate of return of 80% on ordinary shares. Now listen, the rate of return on ordinary share is same as cost of equity. Please pay attention. Those are other names that are used. Should be fine. So find the rate of return on ordinary shares the same as cost of equity. Now, so the cost of equity in this company, Algo, it is 80%, which has the beta, and the beta of this company is what? 1.2. It doesn't change. Then the expected return on the market, this is the return on the market, the RRM. It's universal. This one is for all the companies in the market. Is 7%. What will be the expected rate of return on ordinary shares, which is after the cost of equity? What will be the cost of equity on this other company, Rigel, which is participating in the same same industry, and they share the beta of this one is 1.8. So first of all, what you want to know at that point is to know the risk-free rate, because we have the return on the market. This one they share, all the companies in the same industry they share. So we can use the data that we have for Rigel. Cost of equity is equal to the risk-free plus beta times the return on the market minus risk-free. The risk-free rate we don't know, but cost of equity for Algo we know. We are looking for risk-free. His beta is 1.2. The return on the market is 7 minus the risk-free. And let's work out for risk-free rates. We shall have 8 equal to the risk-free plus 8.4 minus 1.2 risk-free. And collecting like terms together, we just want risk-free. You find that the risk-free rate is 2%. which means every firm is using 2% as the risk-free rate. Then now that we have the risk-free rate for this company, you can easily now find for Regal company. The cost of equity shall be given as the risk-free plus the beta of Regal times the return on the market minus the risk-free. What is the risk-free? It is 2%. Plus the beta of Regal is 1.8 multiplied by the return on the market, 7%, minus the risk-free is 2 as well, right? I mean, not just express them as percentages. So that you can have 2 plus 1.8 times 7 minus that is 5. And when you do your computations, that should give you 11% as the cost of equity for this company. So in short, whenever you want the cost of equity for each company, you just need the return on the market, all right, the risk-free rate, and that's that. For example, example number 9, let's look at it. The risk-free rate is what? 7%, right? It's 7%, isn't it? This is risk-free. The return on the market, RIM, is what? 11%. You are told that if beta is what? 0.9. What is the return on the shares? So cost of equity shall be risk-free is what? 7% plus the beta of 0.9 multiplied by the return from the market, 11 minus 7, the risk-free. That's what we are sending. That's the message we are sending. Then you can find the cost of equity. So this is your cost of equity, 10.6. So basically, that's all about finding the cost of equity. This is cost of debt. In the next class, I think we should start looking at the cost of debt. As for today, we spent most of the time looking at the cost of equity. It's the longest. Cost of debt and cost of preference shares is easy, but the longest is the cost of equity. All right.